Upstart is a company that just IPO'd, I believe, in December. So this is brand new to the public markets, but one that I think a lot of folks were excited to see go public because it's another one of those companies that's really helping reshape the space of finance and in particular lending, right? I mean, in banking, we've been so used to sort of that stereotypical stodgy big bank environment. You just go into the bank, you get your loan, and then that's that. Companies like Upstart are really changing that model around. So we wanted to dig into this one today for listeners. Let's start just from the 50,000-foot view here. What does Upstart do? How do they make their money?
Well, like you said, they're a pretty recent IPO, and given the times, like every other IPO, they've shot through the roof since they went public. They're up 84% since day one, which is 4 weeks ago. So that's really not
Wow.
that much time. Upstart is a personal lender. That's pretty much what business they're involved in right now. When we get to SoFi, you'll see they're in a bunch of different types of financial businesses. Upstart is a personal lender, and like most of these fintechs, their main premise is that traditional banks either are not convenient enough or just don't serve the population well enough, and they aim to solve that problem. In Upstart's case, they want to assess risk better than banks do using they were founded by former Google people, just if that helps. So they want to assess true risk, as they put it. They use over 1,600 data points, not just the FICO score. They use 1,600 consumer data points to get a really good picture of someone's risk profile. For example, did you know that having a college degree is an indicator of better loan performance? So,
Seems reasonable. Seems reasonable.
right. So they use things like that. If someone has a mediocre credit score, but they just got out of college, that's something they would consider in their algorithm.
Yeah.
They also have, because of their kind of over 1,000 data points, they're willing to look at consumers that have lower credit scores than a lot of other personal lenders. According to our review on our Ascent personal finance page, Upstart loans with as low as a 580 FICO score, which is well into the poor credit range.
Yeah.
So they're targeting that kind of the overlooked consumers by traditional banks. They make personal loans of up to $50,000. They've made over 600,000 loans so far. They're growing pretty impressively. The revenue grew 44% in 2020, which, I mean, I wouldn't expect a lender to grow that much in 2020, but
Yeah.
that's pretty impressive. And the thing that really stood out to me about that 600,000 statistic, 70% of the loans they close are fully automated, meaning that
Wow.
they don't have like no labor cost involved in starting them. They're just done by the algorithms that the company has developed since they were founded in 2012. So it's a
That's
pretty
really
impressive
impressive.
company.
Yeah, I mean, uh, this reminds me a little bit of a company from a little while back. We've talked about it here and there. A company called Zoom, XOOM, not Zoom Video, but XOOM, which is a financial remittance company that PayPal ultimately acquired. And Zoom was a company, I think it was really a little bit ahead of its time almost, in that it was kind of at the forefront of this AI powered finance model, and they essentially, like, remittance isn't anything new, right? Western Union's been doing it for over 100 years, but they kind of rested on their laurels, and Zoom got in there and essentially started using artificial intelligence and data points and automation in order to make this an easier experience. And also along the way, really, and this was a statistic that stood out to me with Upstart, in 75% reduction in loss rates in regard to those loans that they're lending out there. And I think it's a testament to the power of all of those data points that you were talking about, because that was an advantage that Zoom really built out in building their risk model, was ultimately building out these data points that help them assess risk far better than these traditional players in that remittance space. And ultimately, what it resulted in, Zoom was really taking a lot of share. PayPal saw that, jumped in there, made the acquisition before they got too big. It made sense. I was a little bitter, as listeners probably know. That's okay. Don't worry. Still own PayPal, so we got part of it there. But it just showed me really, even back then, the power of using that data in order to assess risk better. It's not just lip service. It really does work.
Yeah, and I mean, it's on that note. It's interesting to point out how Upstart makes its money. Upstart's not a bank itself,
Right.
like a lot of these fintechs. They partner with banks. Upstart gets referral fees. They use their algorithms to find credit-worthy borrowers that the system has overlooked, and partners with banks who make the actual loans. And Upstart gets kind of a referral fee for its services. So Upstart is not dependent on it's not taking on a lot of credit risk, in other words.
Yeah.
So it's a fee income business model. They're a connector. They connect banks with customers that they otherwise wouldn't connect with. So it's an interesting business model. They claim there are millions of potential borrowers that are credit worthy, but not by traditional, FICO scores and other bank metrics.
I think that's probably right, and I mean, I think you're seeing we've seen some adjustments to the FICO score in order to make it a little bit more modern and account for today's consumer. Another company that we've talked about on the show before in a firm, I think John Maxfield and I did a show a little while back where we went through a firm's S1, and there was just an interesting data point in there that really spoke to how consumers view the state of finance today. It's really gone beyond just banks, and it's more about tech companies partnering with banks, and just some numbers behind that. A survey that was conducted by the Harris Poll back in 2020, way back in 2020, said that 64% of Americans would consider purchasing or applying for financial products through a technology company's platform instead of a traditional financial services provider. That sentiment rises to 81% for Americans aged between 18 and 34 years. So, I mean, there is data there that shows more and more consumers, particularly even younger consumers, really are trusting of a lot of these tech companies that partner with financial service providers in order to ultimately get done whatever they need to get done.
Well, on a similar note, like that age group you were just referring to, a lot of them skew toward being self-employed, another
Yeah.
area where banks, I mean, myself included, I mean, I'm not in the 18 to 29 age group anymore. That'd be nice, but
No.
I am in the self-employed group. And that's a group that historically banks have not been very easy to deal with.
Yeah.
I mean, I don't know if I don't know if you've ever been self-employed, but if you go to apply for a mortgage or a car loan or something like that, there's a lot of hoops that banks make you jump through. And that's a market that this non-traditional credit model by companies like Upstart can really help solve.
Yeah. Yeah. I've never been self-employed. But I did, I worked at Bank of America for a couple of years, and I was a loan officer there. And I did go through the process of getting some small business administration loans done for folks who were self-employed. And even back then, granted, this was wow, 15 years ago, maybe even more. But even then, I mean, I was just astounded at how difficult it was. And you could see the frustration from the clients when they came in and you had to call them back in, or you had to call for more documentation and needed another signature. And I mean, technology then wasn't where it is today. So I can imagine that it really resonates with that younger consumer. Let's talk a little bit about what the advantages of this business really are. I mean, I think we've homed in on one there in artificial intelligence and using data to make decisions. What else stands out to you about this business that makes it special?
Like the technology is the proprietary element of this by far. Is that algorithm, that the whole non-traditional risk model that they're doing,
Yeah.
that they're and the fact that they're willing to really bend on FICO scoring. A lot of other lenders, SoFi, which we're about to talk about in a few minutes, um, follows a non-traditional lending model, but also wants to pursue generally high credit borrowers. So they're Upstart's really pursuing that. I'd call it the mid-level credit, like the people with fair credit that all the other companies are overlooking, and they try to do that area of the market better than everyone else. And that's if so far, like you said, a 75% reduction in loss ratios, it looks like it's working so far. So if that technology is really that good, then that's a big competitive advantage all by itself.
Yeah, it can be, and certainly it does seem like this is another business with. I don't want to say founders leading the way is necessarily a competitive advantage, but it's certainly a sign. It's a sign that leadership is in the same boat as investors. I mean, this is a company. I mean, one of the co-founders, David Gerard, who's a CEO of the business and co-founder, owns I think somewhere in the neighborhood of 16% of the shares. It feels like this is a good management story too.
Yeah, and to be fair, I'm usually more excited about a founder-owned business, years after its IPO.
Yeah.
Most of the big tech companies that have gone public recently are founder-led. But no, that is a big advantage, especially when one of them still has a lot of skin in the game like that. I mean, the company right now has just under a $4 billion market cap. So you said about a 16% stake. That he could stand to make billions if this goes well.
Oh, sure.
So that's I mean that's a big motivation. I mean, I know money is not the biggest motivating factor for everybody, but you got to think it's there.
It's listen, money makes people do a lot of things. There's no doubt about it. Let's wrap up with some of the risks or things that we're just keeping our eyes on here. I mean, I think that with any of these types of businesses, particularly in this current market, the way IPOs have been received, I mean, valuation, at least in the near term, valuation has to be at least a concern. Now, with that said, I mean, this is also a business that actually has recorded, I can't believe it, positive net income. Matt. This thing is actually profitable.
It is. At the same time, it's trading for about 20 times sales, not earnings,
Yeah.
20 times
Hmm.
sales.
Yeah.
That's a big multiple to pay. I mean, a lot. To be fair, it's not the only tech company with a high value. But I got to believe the biggest risk is not just valuation. It's got to maintain its growth, and there's a huge element of competition risk in this space.
Right.
I mean, right now, like I said, their biggest competitive advantage is their proprietary technology. If they can address that area of the lending market, which is millions of people, better than anyone else, they're going to keep growing like this.
Yeah.
If someone else comes along, and there's no shortage of alternative lenders in the market these days, that space is really blown up. I mean, it started with Lending Club, about 7 or 8 years ago,
Hmm.
and now if you go to the Ascents page, we have reviews on like a dozen of them. So if someone else figures out how to address that market equally well or better, um, then you can see a lot of competition risk. So it's not as no risk investment, and it's really priced for a lot to go right in the next couple of years.